Good afternoon and welcome to Automotive EV. I'm delighted this afternoon to be joined by Christoph Stürmer from PwC, who is going to go through, the title is 2021 Picking Up the Threads. And I think we've quite a number of threads to be picking up at the moment. And regrettably, we've started 2021 as we hoped we would have left behind towards the end of 2020. But here we go. So nice to welcome you, Christoph. Thanks very much. I'll now hand over to you. And anyone who wants to ask any questions directly, please use the site or email me and we'll get them delivered to you. So it's over to you, Christoph. Thank you.
Thank you very much, and welcome everybody from Frankfurt, Germany. I actually made it to the office in spite of rather harsh lockdown measures in Germany. You've probably seen this. And yeah, the good message is we all survived 2020, at least everybody who's here, and those who have not, we regret very much. The question is, what are we to expect about 2021? And is there anything that we can learn from the way that 2020 unfolded, especially in the last couple of days and weeks? So I'd now like to share a presentation with you that we've been sort of updating regularly ever since let's say, COVID events started. Peter, can you confirm, is it visible? Excellent, thank you very much. So yeah, of course, it's the C word that has very much or mostly been impacting the automotive sector very strongly in the last year. As we said, a couple of things fell to the side, and I would like to start with a view on the economic side. And it is entirely out of coincidence that the UK takes first position in this chart, which basically shows the absolute decline of GDP during 2021 as compared to a GDP level of 2019 in purchasing power adjusted rates. This is something that our economists tend to add. And the UK actually, as an economy, was the hardest hit of basically everybody on the chart, which may have to do with the fact that, of course, there was not just the C word, but also the B word to consider. If we look into other markets, other major markets around Europe, we find France very heavily hit, Italy heavily hit, and then sort of average in the Eurozone, which is a volume adjusted average for the Eurozone countries, minus 7.6%. I mean, minus 7.6% is a very, very deep gap. It basically means an average income cut of 7 cents to the euro for everybody on everything we do. That is quite massive in an economy, in an economic system that is basically built to grow between 1% and 2% every year. So the absolute shrinkage is not just an absolute shrinkage, but it is an even larger departure from the expected trend, which we're all investing for, which we're all striving for, which we're all planning for. Then we're seeing that sort of we have this middle group of highly industrialized countries like Germany, Canada, Japan, South Korea. The common element between, it's very hard to find a common element between the countries that are hard hit against those that were not so hard hit. A hypothesis has been formulated that the more service-oriented economies like India, like UK, like France were hard hit, and the more industrial ones were not as hard hit, taking Germany and Japan as an example. I don't know, because for each of the examples, you have a counter example as well. So I think all that we can do is state it has been brutal, absolutely brutal. These are no small numbers, but these are very significant numbers. And especially due to the extended and repeated impacts that we've been facing, and I will illustrate a little bit more, we're afraid that we're really seeing structural damage to economies. And one of the indicators is, of course, unemployment, but it is, let's say, not so much nominal unemployment. If we look a little bit deeper, the informal sector, let's say the micro employment, the extra job, the evening job, that sector of the economy was basically wiped out last year. The sector that survived, more or less limping, is the sector of permanently employed people of middle and high salaries who were either pushed to sort of into involuntary vacation or some other means to not push them out on the street. But the informal sector basically completely vanished. On the other hand, we've just recently seen a statistic basically indicating that black labor, undeclared labor, is basically coming back because the people that used to have declared micro jobs before are now coming back and are not declaring them anymore because they want to keep the money. And so this is something where we're really seeing structural shifts in the structure of employment that we're only starting to understand. On the other end of the scale, we're seeing Turkey with a nominal plus, which only has to do with the fact that 2019 was an absolute disaster for the Turkish economy. A little bit of a plus in Ireland, well, masters of finance. And then China, where, of course, we're getting the numbers, we're seeing the numbers we're supposed to see. And, well, we were supposed to see a growth in China at the end of the year. So we're seeing one. How do we expect things to unfold? And this chart is sorted by expected growth of GDP in 2021. So in this year, the year after. And here, the order is somewhat shifting. So the highest growth expectation for this year is actually in India and in China, where if we compare the first bar to the second bar, we can see that in India, it is mostly catching up, while in China, it seems to be incremental growth, basically speeding back up to a trend that was basically lost during 2019, but also during 2020, but also in 2019. The E7, which is the big 7 economies, of course, are pulled up by China into positive realms. And then we're seeing France with a significant recovery, Spain with a significant recovery, Italy with a significant recovery, but compare the yellow bar to the orange bar, they're smaller. And this is relative growth. And the bad thing is the relative growth of the yellow bar is small relative growth on a smaller basis, on a basis that has already been diminished by the amount of the orange bar. So even adding up the two bars is not going to give you the net negative sort of loss of economic performance in 2021, but you have to discount the basis by the amount of the orange bar, and then you can only add the growth there. So what we're really seeing is a loss of economic performance, a loss of welfare of everybody in the economy. And this is the ongoing picture, not just for the whole economy, but especially for automotive. This is the theme, I think, that has been mesmerizing us a little bit, where there were these strong relapses in the first quarter or second quarter, depending on when it hit you. And then there was recovery, but the recovery was never more than originally expected for the period of the year, but it was only approaching the expected normal level, almost never crossing it. So there was no catch up. We're looking at an absolute loss of cars sold. We're looking at an absolute loss of cars produced. And the catch up only merely actually happened in China. So end of year figures, as much as we've been able to collect them basically up to noon today. Peter already got nervous that I wasn't going to send my slides. But here we are. These are pretty much the numbers that we expect to get from ASEA later this week. So Germany down 19%, Spain staggering 37% down, France 25, UK 29, Italy 28, and rest of Western Europe somewhere around minus 25 for the full year. Total Europe, a full quarter loss. 1 out of 4 cars not sold. Production slightly less bad, but with different kinds of impacts. We're still trying to understand what actually happened in Spain. In France, minus 45% is absolutely horrifying, especially when we compare it to the fairly good economic performance of the PSA group. So we're still trying to find out what actually happened there. When we look into North America, we're seeing that as a whole, North America wasn't as badly hit in total, especially on the sales side. And I will sing the praise of the US retail sector a little bit later. And then, of course, China. I think at the end of the year, we were almost tempted to call China even for the full year. It didn't happen. There was a little bit of a weakness at the end of the year. But still, they made a great recovery after being the first ones that fell into the hole. Japan, quite hard hit, but not as hard hit as in the previous big downturn. And South Korea doing quite well. Turkey, very special situation, of course, especially on the sales side, because sales were basically annihilated in 2019. Production didn't fare as badly, and basically reflects to a minor degree what happened in Europe. So I really hope that in this lifetime I'm not going to see these kind of numbers again. This is a clear-cut disaster for the industry, and everybody who's been able to keep his shop running is really has done quite well. And I would like to sort of put forward the hypothesis, it was the battery electrics that saved the day. Well, it wasn't. We did an analysis basically towards the end of last year, when we were comparing the original expectations for battery electric and plug-in hybrid production for the full year with what had actually transpired. And the original expectations, and we're using a forecasting source that you're all aware of, were even higher for sales and production of battery electrics and plug-in hybrids than they came out in the end. There have been delays, there have been problems of all kinds of things that did not fail to impact battery electrics. So it is not the case that battery electrics were unharmed by the crisis, but they were harmed to a much lesser degree by the crisis. And as you can see here, the total result of sales in Europe in 10 markets that we're aggregating here was still minus 25%. But if it hadn't been for the battery electrics, it would have been even more. So I think battery electrics and plug-in hybrids didn't save the year, didn't save the day, but they offered a little bit of a, let's say, a positive perspective on what could happen. And it was really one of the very, very few segments in the market that actually showed positive growth, and actually quite aggressive positive growth. So if we go through the months now, for the 10 countries that we're analyzing here, so it's basically the big 5 markets plus for Western Europe, plus 5 electric vehicle markets. We were already at a 7% market share for battery electrics and a 4% market share for plug-in hybrids in March. And then things turned south, almost for everybody equally. And then in the second half of the year is really when things happened, when things started to pick up in a major way again, 7%, 8%, 7%, 9%. And then came December. And December absolutely knocked it out of the park in terms of electric vehicle registrations for several reasons. First reason is, of course, vehicles were increasingly becoming available. Factories are just ramping up to speed, you know, all the new productions that you're a part of. And secondly, there was a certain pressure to get those vehicles registered in order to have them contribute to the CO2 targets for 2020, which are already effective in 2020. And as you all know, there were a couple of, let's say, negative reports towards the end of the year, with a couple of OEMs sort of admitting that they're under pressure to actually make it. And I assume that they pulled all the levers that they possibly had in order to get the last electric vehicle and the last plug-in hybrid registered before the end of the year, before the bell, in order to squeeze out that last gram from the CO2 accountings, from the CO2 accounting. And what you can see here, for December, we can really say in December, the alternative vehicles actually did save the day. The big question is, what does that do for January? Are these vehicles now all pre-registered, sitting there on parking lots, either factory side or dealer side, and will be pushed into the market during the first quarter if there's going to be any demand at all, or during the year, basically clogging up production? Well, we think to a certain degree, but electric vehicle demand and supply is on such a steep slope that we think it's sort of merely going to be a little bit of a dip in an upward slope, in an accelerating upward slope, rather than a real relapse that's going to be relevant for the rest of 2021. So much for this. If we look a little bit deeper into the split of diesel versus gasoline, we're seeing that diesel are actually getting totally hammered. German diesel share was only 20% for the full year, which is basically light commercials plus a couple of big SUVs. Diesels are pushed out of, let's say, the more compact segments big time. There's hybrids with a visible market share, but hybrids have in December been beaten by battery electrics. So the question is, what's the long-term strategy here? So much for looking backward. And I'd now like to sort of run through a number of slides, just give a couple of comments on how we expect things to turn out. And I'd really like to open the floor for questions then. So I'd like to use this chart to explain the logic of the charts that we're going to discuss now. So the black dotted line here is sales in 2019. So this is sales in 2019 per month on a global level. The black intermittent line is actual sales per month in 2020, as much as we were able to collect them. And so basically, we've all been going through this roller coaster over the last 12 years. And we came out on a global level at not too bad of a December in total. So that's 2019 as a base, 2020 as a base. And then for 2021, I have to admit, forecaster's nightmare. we have no idea where 2021 is really going to go. So all I can offer is scenarios. We can offer you a couple of what if scenarios, basically what would happen if this and this would happen. And the big unknowns are, of course, the biggest unknown is, of course, how is the virus going to continue to develop, and how is politics going to continue to react on the development of the virus. So we have basically a double-levered pendulum here. It's not just that we can say whatever the virus is going to do, we're going to see in the market, but there's this transmission element between what's actually happening in the hospitals, on the streets, and what is happening in the market, and that is the political reaction. And this is where we're seeing, this is where the uncertainty comes from, because what we're currently seeing is a lot of knee-jerk reactions by politics of all colors and kinds, just very quick reactions, very opportunistic reactions, quick shots, corrections, super corrections, etc., going back and forth. And because these impacts are so short-lived, we have a new COVID strategy every 3 weeks, basically, by everybody, pointing in different directions. So a forecast is always assumptions-based. And when the assumption space is very unsure, you cannot make a forecast, but you can only work with scenarios. And basically what we have here in the using the classic traffic light color scheme here is green for what if everything goes well, as good as possibly reasonably to be expected. Yellow is what if we have a mixed picture, so that things are going to go as expected. And the red line is basically what if things go bad in a to be expected way, bad, but not like really excessively bad. So we have a spectrum here for the total global sales recovery, and I'm not calling it growth, I'm just calling it recovery, of 6% basically as a base case on the global level. Downside scenario, if things go really bad, we're going to stay in the same hole that we were in last year. And if things go really well, we're going to have sort of a recovery of 14%, which almost takes the world back to 2019, but not quite. And this is this base effect. But this doesn't explain anything. We have to go into different regions because regions work differently. If we look at Europe, our main expectation is the cycle, the very strong pronounced European sales cycle. And in this case, we include UK in Europe as a geographic denomination. So it's basically Europe as the ASEA sees it. We are expecting the return of the cycle. So we're expecting a return of a strong first quarter and a bit of a pause in second quarter. And we expect a return of summer holidays, etc., only on a lower level. Lower level, why? Because there's a couple of people that will not afford themselves a new car because they don't want to. And if they need one, they are going to afford themselves a used car. And this is one of the salient elements that I advise all of you to have a look at for your geographies, especially when you're in the retail and vehicle distribution side. Used car transactions survived last year almost untarnished, like single-digit relapse and not big double-digit relapse. So the demand for cars hasn't gone away. Only demand for expensive cars that you need to take up credit for has gone away to a great amount. And this is, let's say, the good news hidden in the bad news. The good news is mobility and transportation is not going to go away. I just read a statistic from TomTom, the navigation provider, who said that the total number of cars on the road, or let's say the total amount driven, isn't really reduced. Only we have other people sitting in cars and we have different types of trips taken, but mobility is still at the heart and core of our societies. And this is the good news for the automotive industry. So selling new cars as a business really took a beating in 2020, but providing safe and affordable individual mobility has not taken a beating in 2020. And this is one of the long-term perspectives that consultants like us have been proposing already a couple of years, that the automotive industry needs to reconsider its role from just being providers of tin boxes with wheels to becoming a provider of mobility, freedom, and safety for people in their everyday lives. This, of course, is a transition that is going to take very, very long. We think this transition is going to take until the end of the decade. But we believe if this laboratory experiment, this cruel lab experiment, this cruel stress test that the auto industry has gone through in 2020, this is the positive result. The more we're sort of on the mobility side of the business, the better. If you look at service garages, if you look at spare parts, they didn't have, of course they had less to do, but they didn't have as much less to do than their friends from selling new cars. So this is why we think there will be a market in 2021 for new vehicles. But this is also why we think the new car market is still going to be under pressure, because buying a new car is a totally different ball game than buying a used car, especially when you're a private user. Because this event is UK based, I'd like to take a little bit of a look on the UK. I think, and we've seen this a couple of times now, even though Brexit isn't as bad as expected, the auto industry basically braced for impact, and they need a while to sort of unravel from all the precautions that they took. So in my candid opinion, I think we're going to lose the March peak this year again, due to structural factors, due to a lack of demand, lack of supply, lack of everything. So the rest of the year is basically going to play catch up for the loss of the big March that we usually have. So we think the UK can basically make up half of the way back to the extraordinary levels of 18 and 19, etc., but not all the way. We think that Brexit is going to take a toll due to many factors, but also, of course, COVID events. I think many of you have been locked up in tier 3. I think that's what it's called, measures. So there's not too much going on in terms of sales. Let's look at other markets. Germany, basically same story. We think the cycle is going to come back. We think that due to the stampede, the December stampede, which was very pronounced in Germany in December, January is just going to be super weak. And we have since basically Monday, we have a very strong lockdown, including closure of showrooms, which wasn't sort of really pulled through up to now. So we believe that January may be actually very bad and sort of clawing back in the direction of normal, with a bit of a relapse in the second half because of really lacking economic growth and lacking employment and lacking willingness of people to actually spend money on a new car. So basically clawing back as a basic scenario, just 3%, upside scenario, 6%, which is basically consensus. I just read another publication that for a good year, let's say for a positive positive execution of the vaccinations, and not too much unemployment, and not too much delinquencies, they're looking at 6% growth. So I think we're in good company there. France, shaky economics, big impact on the new car market, but comparatively good performance of electric vehicles. So the people with money actually, even last year, afforded themselves an electric vehicle. But the problem is, and we've seen that before, overall income levels and overall income disparity is something that produces a bit of structural weakness in France. So we're not very optimistic for France. France was really beaten up last year, and we believe it's going to take a while to claw back. First quarter we expect to be rather slow due to curfew measures and lockdowns. Italy is still as I see it, consumer sentiment in Italy is absolutely rock bottom. There's a very strong feeling of substantial crisis, at least among those people in Italy that I speak to. So the emotional impact on people's sentiment seems to be particularly strong in Italy. We don't see very much of government activities in order to get people back to work. There were weeks-long lockups. So we think that, yes, the cycle is going to come back, but subdued and maybe sort of come back to normal after the Ferragosto, after the summer break. Special case Spain. Spain, of course, is bleeding from the lack of tourism into the country, both economically, of course, when we look at the islands, etc., but also the automotive industry. There's a very strong rental car sector in Spain, because Spain is so far away from everybody else that you actually don't drive there with your car, but you rent a car. So fleet sales have a big say, have a big part in Spain, as far as I've been running our analysis. And we don't think that rental fleets are going to restock in Spain next year, but they'll run on a very low level. And then, of course, the incentive measures in Spain were very short. They ran out in December. We're currently not aware of a new incentive scheme or a scrappage scheme in Spain. Please correct me if I'm wrong on that. But for the time being, we think it's going to be harsh and slow in this year. And with the snow and cold that we currently have in Spain, no one's even thinking of buying a car. It's just too cold. You remember, I think 2 years back, we had this big cold in the US, and you could actually see it in registration figures. And I think it's going to even be more dramatic in Spain. What does that mean for production? Slow, slow, slow. There are exceptions, of course. Those of you who serve either a premium manufacturer with a fresh product, or a plug-in hybrid platform, or an electric platform, of course, you're working day and night in order to get the cars out. But those of you who serve middle class, middle brand, everybody's car in the compact segment, you may not be needing all of your people, and you may not be selling all of the cars that you were planning to sell. So we think, from an overall volume perspective, production will be hampered by low overall demand in Europe. There will be exceptions, but there will also be brands and vehicles that are going to continue to suffer because their clients continue to suffer. So overall, plus 7% after a decline of 23%. So our production estimate for next year, for this year, is 12.6 million, which is 1 million more than in 2020. I'd be happy to be proved wrong, but I can't see where all the cars should be going, that we could build more. All right. UK production, of course. So we basically think that UK production is basically going to take a big hiatus in Q1 to use up, to sort of figure out what's going on in terms of Brexit, take it really slow. And with the lacking March sales, take it even slower, and then sort of come back. But it's really hard to gauge that, because politics, as well as OEM decisions, can change the picture very, very quickly. I mean, you have a couple of very important products that are not just built in the UK, but that have twin brothers, twin factories somewhere on the continent. And if things don't turn out well concerning the supply of parts or the delivery of finished vehicles, I think some harsh decisions can be taken very quickly. So we have a lot of uncertainty here in terms of what it's going to turn out. If everything goes well, if it goes as planned, then we think there may be a recovery in the magnitude of around 13%, back to 1 million produced cars, which of course is low compared to previous levels, but it's hard to imagine how much more there could be. China, so much for Europe. I'd like to wrap it up here. Now with a look to China, of course, the wonder of the world, it's where it all started, and then they just kept on catching up, basically. And we think there is room for the Chinese new car market to grow even more. The economy seems to be quite healthy as a whole. There's a lot of help from the government, especially for the manufacturing sector, not so much for the consumption side, but for the manufacturing side. And we must not forget, China is below trend as a new car market. 18 was bad, 2019 was bad. So there's room to grow, just back to trend. It's not even overgrowth or anything new. Even if they're just moving a little bit closer to trend, there's potential for them to actually grow. The upside scenario, they have enough factories. They can grow 20%, no problem. They've been there before. We think it's may not be 20%. It may more be like 3% after declining 5% this year. And if they need to go back to lockdown or financial markets crash, it may be a little bit lower as well. US, and I told you I was going to sing the praise of the US retail sector. If you look here into March, April, May, that's basically when US production and Mexican production was basically shut for good. The retailers didn't have any cars. They didn't receive any cars. But because there's 2 to 3 months supply sitting on dealer lots, they kept selling, and they didn't suffer themselves to be closed down, but they picked up the phone and started selling cars to their customers, made them good deals, and just kept the industry going, kept their business going, and kept America going, if you will. So as a whole, we do have a very significant difference in vehicles produced in the US compared to vehicles sold, and there was a lot more vehicles sold. That basically led to a bleeding out of vehicle stocks, available stocks in the US market, but at the same time also to a delay of the introduction of new model year vehicles to the dealers. And they're now basically sitting on empty lots with old cars. Paradoxically, average transaction prices of vehicles have gone up. And why have they gone up? Because choice for customers for new cars has declined. They need to buy what they can get, so they can't haggle as much as they did. In the end, for the individual dealer, that may be good, but when we're looking at, for the individual transaction, that may be quite good. But when we're looking at a 15% decline of total sales, of course, it's sort of a good, a little bit of a good anecdote, a positive note hidden in an otherwise disastrous story. We're seeing big efforts now by the US manufacturers to actually roll out the new cars as much as they possibly can, but their logistics are in a much worse state than we feel for Europe. So what's the midterm perspective? And to be quite honest, we can't tell. We can only give you different paths, and these are not ranges, but these are distinct scenario paths, how things could go. In the yellow path, which we think is the most realistic one, we think that first half year is going to be slow, crawling back to normal in the second half year, basically for global sales, which basically means a muted recovery in 2021 and then picking up speed in 2022 towards the original expectations. Upside scenario basically says everybody gets their vaccine, everybody goes back to work, there's work to be done, and things sort of speed back up rather quickly. That's the green line, which would basically mean a little bit of a bounce back effect in 2021, a little bit of a relapse in 2022, and then continued growth in 23. And the bad scenario is, of course, we're not getting our vaccines. We're going to see lots of companies default. We're not getting the right parts to the right people. People are going to continue to sort of prefer used cars over new cars. That's when we think that we're going to stay a little bit longer in the hole and only start crawling out in 2022, very, very late in 2021, with some signs of life, and then crawl back out in 2022. That's for global sales. What does that mean for production in Europe, which may be interesting for both inbound and outbound logistics? If everything goes peachy, of course, then we may see sort of a halfway recovery in 2021, but that's best case. That's when everybody goes super. We expect to come back halfway. If it goes as expected with a couple of hiccups here and there, we're looking at sort of getting back a third of the way. And if it doesn't go well, we may just see sort of some coming back, but not really to a very large amount, and sort of speeding up of recovery only in 2022. So sorry for being Dr. Doom. These are, as I said, these are scenarios because the assumption base, especially on the politics side and on the epidemic side, is so unsure. We can only offer you what-if scenarios. It may help you plan. It may, and I'm already happy if it helps you sort of categorize your own thinking and support your own planning efforts. If you have more questions, please don't hesitate to ask. And I should also like to add that this is strictly work in progress. This is assumptions out of what we do as per today. Tomorrow, with new information, there may be changes again, but I'm happy to be able to share this with you. Thank you very much.
Thank you, Christoph. Well, there's a lot of food for thought there. And it must be sort of from a question perspective, having looked through, it's one that personally I will keep going back and re-looking through as well, because there was a lot to take in. So absolutely superb. Thank you very much. Couple of parts really that sort of, it's probably an obvious question, but I'm going to raise it anyway. Nearly all the figures pull down in June to August.
Yeah.
On literally every slide, virtually June to August. Given the fact that we are really heavily in this pandemic, we've got extended furloughs, or what you call them in Germany, if it's similar, where people are on reduced wages, but at least they've kept their job. What bothers me looking at those figures, are they reflecting the fact that when the furloughs finish and people have been maintained in sort of employment but not having to work, is that impacting those lesser figures as well? Because there may not be the jobs there when people, they're not going to be that real bringing everybody back when that closes, if we've got major production figures going down the drain and people not buying them. Is that a big influencer in this, or?
Actually not. I mean, the August break is just holidays, and July and August is just holidays. And actually, why do we still have them in the forecast? Because even in 2020, when the industry was actually just crawling out of the lockdown, people were still going on holidays and factories were still being closed. So this is really a technicality. The level, however, on which sort of production is maintained still during the holiday phase, that is a function of how many people are actually still willing and capable of buying a new car. Definitely. What I'm not seeing in the scenarios, and maybe you were alluding to that, is another round of factory closures, like factories being locked up for pandemic reasons. We're not seeing that. We're seeing different levels of distancing measures and etc. But tip to the hat, the HR departments and work rule departments have been working 36 hours per day in order to make sure that everybody can work as safely as possible. And that if anybody coughs, send them home, send someone else in. Amazing, absolutely, totally amazing what is happening there. And I think it's going to continue to sort of balance the pressures, be able to balance the pressures without companies actually having to close. If they can get enough microchips, and some of you may have heard that there's a little bit of a shortage of some microchips showing up. There was a foam maker in northern Germany that was closing up for 2 weeks, but that's occasional, that's random, that's factored in there, but not as a substantial factor.
So realistically, we've actually gone over time, which is quite staggering. So thank you very much indeed. I'm sure there may be more questions, and if that's okay with you, we'll forward them to you, because I think that's going to happen the more this is digested. Interesting factors on the used vehicle market. Lots to talk about really with the demise of diesel and the increase in sort of electric. One question from the hybrid perspective, is that vehicle really just helping boost the current trend as far as getting the CO2s down as much as they possibly can, or is it sort of going to be long-term sustainable? We're looking at sort of hybrids will go to 2035 in the UK, when diesel and petrol will finish in 2030. So there's only a 5-year extra life for hybrid than having to go fully electric.
Well, that's the plug-in hybrid. Plug-in hybrids are basically healing a problem that is a little bit of a luxury problem. So a plug-in hybrid, in the most part that we can see, especially from the German brands, Peugeot is taking a little bit of an exception there. They're solving a problem that is solving itself. They're solving the problem of too heavy batteries with not enough power and not enough rapid charging capability by keeping the combustion engine in the car to sort of compensate for those weaknesses. But those weaknesses of the battery system are being compensated by producing better batteries. So I think there was a time, basically 5 years ago, when plug-in hybrids seemed like a good idea, and it took 5 years to develop them. So now they're basically solving a problem that is almost solving itself. So I think by the end of the decade, the problem will have solved itself.
Perfect. Well, from my perspective, and I'm sure everyone that's watched, thank you very, very much indeed. It was really interesting, which it always is when you come. One quick question. This is outside of really the presentation. From an analytical perspective, are you guys looking heavily as well into infrastructure in relation to the impact and need of charging points that we are going to have?
If you're saying charging points, of course, I mean, this is one of our key considerations. And I think we were one of the first to point out that the auto industry cannot do without the energy industry, and the energy industry cannot do without the automotive industry. I think that with the Green Deal and corresponding politics, of course, in the UK, that are pointing towards a full, very strong reduction of the total CO2 output of the transportation sector, everybody has to chip in. And so it's not just the auto industry, it's the transportation industry, but very much so utilities and energy companies will have to jump in. But there's a lot of business to be made and they still have money to spend. So I think, and from all that we can see, is that investing even energy money into new coal plants has become rather unpopular, and they rather spend their money, put their money in charging stations. They're still trying to play hydrogen as a joker. We can talk another day about that.
Well, we've gone over well and truly now, but thank you, Christoph. Keep safe. We hope to see you again relatively soon to suit you. And thank you, everybody, for tuning in, for want of a better word. And we'll see you soon. Thank you, Christoph. Bye.
Thank you very much.
Bye.